have a good microphone apparently. How's that?
Better. But,
I can move this a little
yeah.
bit.
Ben, I was thinking about the PPI versus CPI. So the CPI didn't show as much tariff pass through it, and so that's what kept people excited. But today the PPI showed, some impact from tariffs. So does
Well,
that,
it doesn't
would
include
wouldn't that
import
imply that
prices.
corporate margins are under pressure?
Yeah, exactly. That's where I was going to go to. It doesn't include import prices though, PPI. So it's not really directly of that. It's just, uh, I think here, look, if you can't pass prices on, you can only eat margin, really, right? I mean, like
Right.
those, like I think one of the great misunderstandings by the average participant, which like most people look at stocks, Bakes looks at charts, like everyone has their own strategy, and like paying attention to all this macro stuff isn't necessarily everyone's like cup of tea or how the things are calculated, but like you got to remember corporate margins are like near the highs, and that's part of the cost structure, right? Like, when you pay
Absolutely.
for something, some portion of that final price is corporate profits. So you can have a situation where the cost of doing business rises and the cost of the final goods or services doesn't rise as much as the cost of doing business. And so you can look at the year over year delta of PPI versus CPI over time. And when PPI is rising faster than CPI, that's when you're going to get your margin hits. And that's why I think stock market getting hit today a little bit. It's like markets, I mean, because the 25 bips is still at 100% today. So this didn't change that at all for September, right? And
Right.
your 50 might be off the table though. Like that starts to throw that chink in the armor on that 50.
Mhm.
But the general idea is the corporate margins are the release valve, if you will, and how the machine works. And so obviously equities don't like margins pressure, right?
Yeah. Two thoughts on that. I agree that the 50 basis point cut for September may be off the table, but at the end of the day, it's going to really be dependent upon what the labor data shows prior to the next FOMC meeting. And as you and I have talked about, we've got this upcoming um, Jackson Hole meeting where the whole theme of Jackson Hole is the labor environment and is it in a transition. And Powell speaks that Friday morning. I think it's the 22nd at 10 a.m. Eastern time. So he's going to weigh in on that in terms of his biases. And I think he's paying more attention to the labor data today than he is the inflation data. But we'll see. I mean, everyone has their own interpretation of what he's emphasizing. But I do think if the labor data in early September comes in weak, 50 basis points could be back on the table. But I agree. Right now, it's not.
I would say that
Mm,
if it's anything similar to how the last jobs report went, then yeah, you're right.
yeah. And then the second thing you were talking about was corporate margins, and I absolutely
Right.
agree with you. I mean, we're looking at 264 in earnings for the S&P 500 for this calendar year of 25, and $302 next year. And the only way you get there on mid-single digit revenue growth is margins holding up or expanding. And I just, in light of these tariffs, I just don't see it. And so I
Yeah,
think corporate earnings are very vulnerable to just disappointing next year.
yeah, and I think that's where the rubber meets the road of
Mm.
like what can be priced passed on, what can't. If we think about 2020, 21, the government actually just put money in people's bank accounts, true printing of money, and then you had people sitting in their homes, not having to spend money at restaurants and cruises and vacations, and so they were saving money. So then coming out of that, the government, not government, the private sector had a lot of pricing power. People were looking to spend. They had a good balance sheet. Asset prices were going up, and they fixed out their liabilities, and credit was available. So, you know, country or not country companies for the first time in my whole career were really passing on price, and they got away with it because the balance sheets of the private sector households and the spenders was in decent shape, and there was all this extra money that was put in there. Well, that's not the situation now at all. So now you have costs rising, collections on student loans and, the FHA thing that we've talked about, combined with not nearly as much fiscal spending. There's some tax breaks, but like, again, you go back to Reagan in his first midterm, they did something similar where it was a lot of the CBO is like, oh, this is deficit expanding. Well, if it comes through taxes, that's a slow moving stimulus. And if it's helping just the top of the stack doesn't really need any help right now, right? Like, I don't know how much that then flows through to the general economy. So it comes back down to like corporate margins being the top thing, I think, because look, my Goodyear tire thing on last Friday, well, the revenues are fine. They passed on like 4% of price, but volumes fell off the cliff, and then so operating margins go from 8.9 to 5.3, and the stock followed the margins. So I think that's instructive of what can happen for a lot of guys, basically.
Yeah. And I'd like to bring in Bakes here on this conversation because I'm going to mention Tapestry here at the top of the show, symbol TPR, and Bakes will vouch for me. I had told Bakes I had shorted this about 2 or 3 weeks ago, and on the theory that the consumer spend for the aspirational consumer would be disappointing. And honestly, what we got this morning, so Tapestry reported this morning. Oh, by the way, we also, Bakes, appropriately pointed out that this stock was very extended relative to its 200-day moving average, and I'll leave that to Bakes to talk about. But what we got this morning was, a lowering of 26 estimates. I think they came. The estimates coming into this morning were 549. Tapestry lowered the guidance to 530 to 545. So the lower end of the guidance is very disappointing, and they specifically cited the margin pressure from tariffs, and they said that was going to offset entirely the underlying improvement that they were generating from their strategic actions. So margin pressure is very, very apparent in this story. Bakes, I don't know if you want to talk about the chart a little bit and give some people some guidance.
I don't know if we did it offline or in stockings. I can't remember, but we talked about that. Yes, this was extended. The percentage above the 200-day here and here, 2 days ago, was about as wide as it's ever been. And I said, if you want to buy the puts or short the stock, have a stop, I don't know, 5% above the high, just in case the earnings report is something that's astonishing to the upside, and obviously you get the opposite. So here you have a gap down. All these people are ticked off and losing money, and I think this 90.85 level, this prior high back here in February, is probably where it's close to there now. And I'm always interested to see how we close. Do we close near the high or near the low? But fabulous short or buying of the puts, and good for you.
Yeah, and we talked about it with Berna a couple of weeks ago on the show, and that's when I mentioned the 200-day moving average overshoot, and I was expecting it would at least come back to where it broke out. So what did you say, that was $98 or something like that?
90.85, 90.85.
Okay.
All right, let's get going. It is August 14th, 2025. And this year is going fast, guys. Yeah, I am Benjamin Bry. I'm your moderator today, joined with the very colorful shirt, Charlie Peabody, and our in-house technician, Kevin Bakes Baker. Let's get it going, guys. We have, after 2 really green days, although let's say yesterday there was some cracks when you saw the high beta names were off quite a bit. I mean, and CoreWeave, which could be a little canary in the coal mine. Remember, CoreWeave is data center company, came public in March, really couldn't come public very easily because the AI CapEx spend story was stalling out a bit. Then it re-got its legs after April and went from 432 to 175. Well, now it's at 111 this morning after earnings and heavily shorted. But the banks didn't trade very well yesterday, and the tech stuff didn't trade very well, but everything else traded fantastically. Today we get a pretty hot PPI, and the market's getting hit a little bit, which is the first time it's gotten hit since the employment report, if I remember correctly, which was a bit of a jolt day as well. So things are a little jittery. Vol's low, so we've kind of got up there. Let's start with Charlie. What are you seeing? What do you want to talk about today?
Yeah, just on the follow up on the Tapestry comments and the consumer, in around the 15th of the month, we typically get the securitization data from the credit card companies. And there are two things you look for. One is what are the credit quality trends, delinquencies, charge-offs, and then what are the volume trends. And a lot of these card companies have been tightening the credit box over the last year and a half, 2 years, and therefore, the credit quality numbers, delinquencies and charge-offs have been improving as a result of that tightening of the credit box, getting more stringent in their underwriting standards. But what has suffered in the meantime is the volumes, the revolving balances have been slowing. And so that, this report which will reflect July, is where you would start to expect a seasonal deterioration in credit quality, typically. So you've had this improvement in credit quality up until now, and then you're going to get this deterioration in credit quality going into the fall, winter. The question is, can they offset it with improved volumes? And if you don't see any improvement in volumes, that's going to be very negative for the consumer outlook. And that was one of the things I was anticipating, only one of the things, and it wasn't the major thing, but one of the things I was anticipating when I shorted Tapestry TPR a couple weeks ago. But anyway, I just wanted to mention that up front because we were talking about the consumer and Tapestry and other things. So really what I want to focus on right now is the housing market, something I've been talking about, I think, since the fall of 24, when I started to build the bear case. And we get some data early next week, two pieces of data early next week on the housing market. And into this data, we've seen a fairly good bounce in the home building stocks. And I've said, I expected a dead cat bounce in these home building stocks, but I really don't believe that the underlying fundamental story is improving. Now, one of the reasons I thought we would get a bounce is because of Ben's thesis, and I have bought into it to some extent, and that is that we'd see a benign rate environment that might improve affordability. But I said, that dead cat bounce is then going to be followed by the second leg of the bear market, where unemployment rates rise and people, have trouble, continuing to afford homes. So the first bear leg, which was really from the fall of 24 into the spring of 25, was all about affordability, the lack of affordability. The dead cat bounce we expected to happen in the spring, summer. We've gotten much of that already. And I think we're now entering towards the second leg of the bear market, which is going to be all driven by higher unemployment rates. So let's look at, so on next week, we get two pieces of data. We get the NAHB sentiment indicator, the National Association of Home Builders indicator. And projections are for that to be around 33, which is, sort of the levels you were at, pre-Great Financial Crisis, back in 2007. So it's not a good number. It shows a very poor sentiment amongst the home builders. And then the second piece of data we get next week should be housing starts. They're projected to be around 1.3 million. I've always said when you get housing starts down to 1.2 million, that's sort of indicative of a recession. So again, very depressed levels of housing starts. Now, the reason that I'm expecting, weak data from NAHB and housing starts next week is what we're showing on the screen right now. The pending home sale contracts right now are at, all-time lows. So these are contracts on homes that have been sold but not yet closed. This index usually leads existing home sale data by 1 to 2 months. So it's suggesting that existing home sales continues to be very, very poor. Jenny, if you can go to the next slide. which should show new home sales and existing home sales. Okay. So this slide shows on the top the new home sales over history and existing home sales. And the simple thing to point out is that new home sales are a 3-year low, where existing home sales are a decade's low. So again, the environment for home sales, because of the lack of affordability, remains very depressed. And then the final slide, which I kind of like out of all of these, is the months of supply of both new and existing home sales. And what this shows you is we've got about 5.1 months of supply of new and existing home sales. 6 months is considered kind of in balance. So technically, this would suggest that we still have a tight supply of housing, but deteriorating. Now you break up the components, and then you're going to see that the new home supply, which is really the important part for home builders, is at 9.8 months supply. So what it tells you is that the new home builders are still dealing with significant oversupply of their own product, and a lot of that is spec building. So the only way they're going to clear that in a period of reduced demand is through incentives, and those incentives are going to mean that margins remain under pressure. So I think if the demand worsens because unemployment rates rise and you've got this excess supply of 9.8 months, the margin story is going to continue to get a lot worse. So I think the home builders, which have had a nice bounce here, are getting closer to the point where I want to reshort them. I have not pulled the trigger yet, but they're getting very close to where I want to reshort them. So that's kind of the story on housing. Ben, I don't know if you want to chime in, or Bakes, you want to talk about the XHB charts, or Lennar, or DR Horton, or any of those?
Bakes, you can start. Go ahead.
I mean, here's the XHB. I put the arrow up here. This is August of 2024. This is when Charlie started talking about this. Here's the swoon into.
Bakes, we don't see your charts.
Okay, I don't know what to do.
Okay, share screen.
I did.
There's a little button in the bottom, share. I guess you're kind of like Charlie, not good at sharing.
I thought I was sharing at the beginning. I don't know what happened. All right.
There it is.
Here's XHB, and this is August of 24. Charlie's first call. Here's the swoon into April, the spring, and then here's the dead cat bounce on relatively low volume. So I'm with you. Yesterday, this is indicative of another one. Here's Lennar. Nice bounce. I'm not dazzled by the volume. You're into resistance. I don't think it's a trend reversal at this stage of the game. It's nice, but I think you've got to work through all these people that have been losing money up here. You can see my arrow. I don't know how heavily shorted these are. DR Horton, same kind of thing. It's a nice bounce into resistance, but I'm not sure it's anything more than that. And I was struck by crazy names. Here's Pool. That looks like it wants to get off its tail, but I'm not convinced yet. So for right now, it is a dead cat bounce, and until you see some more price action and the volume pickup, I'm from Missouri.
Okay, I'll take the other side of all that. Those charts all look good to me. Look, the reality is, when you pay attention to the interest rate curve, you see what's going on, and the 15-year mortgage is now below 6%. The 7-year, 6-year floaters at 6%. 6% is a big number. And, as the front of the curve continues to come down, people will go into the floating. So the 30-year fixed will slowly come down, but it won't matter as much because initially people will move into the floating. And if you remember, post the last .com, we dropped rates. And that was where a lot of the activity came from, was interest only and floaters and stuff of that nature. And so I think, this move that we just had, because I talked about on the show yesterday, my biggest positions were long Rocket Mortgage and UWMC, which are mortgage, home finance companies, pure plays on this, because the problem with home builders and building materials and the furniture companies because they got to still deal with the consumer. They got to still deal with the supply chain, more importantly. So that, there's issues there, as I mentioned, with a lot of these things. But the rates come down, and if the rates come down led by the front, which they are, then the mortgage, I mean, you don't have to go back, but like Charlie's chart of pending home sales, like existing home sales, I mean, we've been in a depression. Like, we're in an outright depression. And as rates come down, there's a lot of people that are going to refinance their homes, going to get like this thing going a little bit again. And so you can have a situation where rates come down and we don't have an outright recession, because this can be very helpful to the average guy. And so I'm taking the other side. I think this is like the beginning of a breakout. But again, things move in a way where we got a big fast move. Sometimes they got to consolidate, right? We got to see what they're made of. We got to see some real returns or some real numbers, not just hype. So I think right now it's anticipatory, but I'll tell you, the UWMC, their last week, they said they had the best quarter since 2021. And they, the guys, one of my buddy runs a wealth management program, said he's gotten the most incoming mortgage requests for some of his high net worth guys that he's had in years. So I think this game's starting. And whether and again, I just want to reiterate, we're coming off a low base, like a depressionary level of activity in housing. So it's when you go from the old saying is the best returns are when you go from absolutely awful to just terrible. And that's kind of like what we're seeing in the beginning here, is my opinion.
Yeah. Ben, my position has been, the first leg of the bull market would be a function of affordability. And then, this spring, summer, we said, okay, the rate structure is now starting to get a little more constructive. So yes, you can have a bounce. And that's going to be the determinant of how big a bounce you get. But if we don't get deterioration in the unemployment data, then the second leg of the bear market is going to be pushed off or postponed. So my second leg of the bear market, and that's why I said I haven't pulled the trigger yet, I'm waiting for some visible signs of the deterioration in unemployment rates. So if I start to see, for example, continuing claims above 260K, that to me is kind of a level where I'll start to say, okay, I think unemployment is going to be a problem for the housing market. So as long as the employment data remains robust, then yeah, you probably still have some more upside in the housing.
Yeah, I think it's going to lead it, Charlie. I think it's going to be the opposite. I think it's going to like rates make it more affordable, and then that gets activity going, and then you get the ball rolling, and you get construction and housing related, which is the highest multiplier of the private sector in the U.S., to start adding jobs. And maybe I really think that the problem that we have is in aggregating stuff. There's two economies post COVID, right? Like there's the average person economy, and then there's the top of the stack economy, and that exists both in stocks, or corporations and households. And so the IWM of the world, or we could call the middle class, has been in an absolute recession for a while, like
Right.
for years. Okay,
Right.
so we're that part of the economy has been in a recession, and the top of the economy has been in this raging bull market where you work at Microsoft, you work at Meta, you own a bunch of portfolios, you own assets, like you've been in a just unbelievable bull market. And since the power law distribution of the market cap and of spending is such that the tops outweigh, the small percentage of the top outweighs all the rest, the aggregate looks like that in essence. And so I think that like it can surprise people that we have two economies, two markets, and you get a situation where the IWM, like what we just saw yesterday, IWM's crushing, or last 2 days, IWM's crushing, QQQ and Spire flat to down. And I think that's a preview of what we come to see. And I think interest rates going down is helped by employment going down. And so I hear what you're saying, but unless you expect this to be, some massive recession where, the unemployment rate goes to the sky, I just think that it's already kind of there in for some sectors, and so it will just be a shift maybe from healthcare and the government giving all the jobs to maybe the private sector starting to add jobs. Private sector jobs have been in contraction when you cut out healthcare for a while now. So, I think we're sitting there. It's just weird because the S&P is at the all-time high and the aggregate data is like clouding some of this underlying weakness in the middle of the stack, if you will.
Yeah. Well, I want to talk about soybeans and bungie, but let's give Bakes. I know Bakes has some charts he wants to go through. So Bakes, why don't you chime in here?
Okay, I'll go through mine. But if you want to talk about BG right now, I'm happy to do that as well. So you tell me.
Now we're running late, so why don't you get your stuff
Okay.
in? We have time.
This is Expedia Group, and I mean travel is screaming. It just this is a great looking chart, and it's accompanied by Carnival and others. Um, so this segment of the economy, whoever wants to travel someplace, and I don't think of Carnival as a an affluent consumer. Maybe I'm mistaken, but maybe it doesn't matter. The people are spending money to travel. Viking looks good. Carnival Cruise Lines, Expedia. So the travel stocks just caught my eye, especially on a big earnings report taking this out. Full disclosure, I don't own individual stocks. I don't own this, but you know, the travel names look really, really good right now in the face of economic news that seems to be negative.
Yeah, I would note, like on the CPI report earlier, we've had 9 months of hotels rooms being in deflation, and so the travel is a weird spot because people are like, oh, there's less travel, but then you look at the TSA passenger data that's readily available. I mean, I get it on Bloomberg, but I'm sure it's available elsewhere. We're near the highs. These stocks look to be doing pretty well. And so it could also be back to what I said about a dichotomy within the system. The olds basically have all the money and they're kind of in retirement mode, so it makes sense that cruises are killing. That's like the pure play on boomers, right? And some of the travel. These people have all this money and now they got a bunch of time. So I would love to see some way of, like, I don't know if this data is available, but who is the ones who are traveling? Who's the ones who are spending? I would bet it leans heavy old, and I don't know if that changes. I mean, that would probably require the S&P to start going down for those decisions to be made. It's kind of the same kind of concept, but I mean, those charts look good though, Bakes.
I feel very uncomfortable because usually I'm very much in sync with you, Ben, and you, Bakes, and I'm on the other side of not the cruise lines, but the hotels. I'm shorting the hotels stocks.
Well, they've been doing poorly. That's what I'm saying. Like, we had 9 months of deflation in hotels in a row on the CPI report, but it could be one of the reasons why Expedia is doing well, right? They're like, hey, you need to get filled. Well, here, and then their margins go up, and then the people who want to take trips, maybe they're more deal oriented shopping at this point, so a middleman starts to take a little share. The cruise is unbelievable, though. I mean, the
It
move
blows
they've
my
had
mind.
since COVID is just unbelievable.
I mean, so Viking on the high end and Cardinal on the low end, they both look great. This is Airbnb, which looks like it wants to roll over. They didn't like their earnings report, so frankly, I'm more confused by this than anything. But
Yeah, I think it's pocket by pocket. That's what I'm saying. I think it's
yeah,
hard. I think what we don't want to do here is say some broad stroking statement. I think some segments are weak, and I think some segments, like, again, the cruises are just a very pure way of playing retired rich boomers, and they're doing well. Airbnb not doing as well. Like, hotels not doing as well. So yeah, and even within, let's talk about like parks, right? 2 weeks ago, we get Six Flags with a terrible report. Stocks down 25% that day, and they lost million plus visitors year over year. Whereas then you go to Disney, and Disney Parks was up 10%, and now maybe Disney was not running things correctly. So it is, to your point, it is not as easy to make a broad stroke assessment on travel. I think there's a lot of beneath the hood. You got to know exactly what they're doing, what segment they're serving, etc.
This is Six Flags. When you make your stock symbol fun, it becomes
It doesn't look like a fun chart.
it's not a fun chart. It becomes ironic after a while. So
It's a flagging formation.
now,
Falling
okay,
formation.
UAMY. This is a Charlie name, and I should have checked with him because I hope he's still there. But this is United States antimony, and rare earth used in a lot of military applications. And I just point this out because earnings were very good. The stock liked it. The volume is monstrous, and again, I should have checked with Charlie. I'm sorry I didn't.
No, unfortunately, I'm gone, Bakes. But
Okay, I knew you would be.
I had a quadruple.
I was afraid you would be, and I'll go down to Connecticut and tackle you the next time. If now I know you probably doubled or tripled your money on this, which is wonderful, but all I'm saying
More than that. More than that.
If it take okay, good. My point is that if someone new comes along and it takes out this all-time high back in 2012, then everybody's happy, everybody's making money, and I know it's up a lot. I understand that very much so, but it just
What is an RS99 rating? Relative strength?
Relative strength.
So that's in the 99th percentile, basically.
Yes.
Tough to buy 99 percentile. I'm not very good at that.
Yeah. Okay. Do we just?
No, I mean I know it works sometimes. I'm just saying, like I something in my brain says no. I don't know why.
And that's why that's why we do this. I mean, there's something I think for everybody here at Wall Street Beats, but you could it was this
looks good. Looks
the
good.
strength was probably 99 here when it took.
Yeah. I get it.
Yeah.
I get it. I was just trying to understand what that was.
And I just told you everything I know about antimony. I mean, I don't even have a commodity chart for it, but that's a positive chart. And if it takes out this 419 level that's over here, then you probably have more fun coming. Now, but God bless Charlie. He's taking his money and run. That's wonderful. But I pointed it out. Now the last one I have,
just Bakes. It's a defense play, not a commodity play. Or I don't know who said commodity, but it's a defense play, really.
No, okay. So yeah, I know it's used in military applications.
Yeah.
But the last thing, part of it is the MP news with the Department of Defense, and people are saying let's go into rare earths that aren't in China. And so here we go. I don't know what CPI or PPI had to do with romance, but Match Group. This looks like, this is more I think your alley is. When something gets this is a knife that's on the ground that's safe to pick up. It looks like to me. And as somebody mentioned it here prior, I can't remember which one of our partners did this. But Match looks really interesting. It doesn't need much. It gets above this. That's the Luis Yamada base. Charlie back here, and we'll see if it can do something. So, and I don't have a thesis why this might be perking up, but Match Group love is in the air. So here we go.
I own the Match.
Okay, maybe it's your
I pitched that on the show in June of 24.
Okay.
June or July of 24, and it's kind of just sat there. They're producing free cash flow. They're hanging in there, but it's it's not been like great stock. It's just kind of it's been okay, but I like it. It's cheap.
Well, then look at here's the change. The volume you've washed out the sellers, and the buyers are coming back, and maybe they're short sellers covering. That might be okay, but that volume is a tell that the sentiment has changed here, especially with an earnings report that comes out. The relative strength is 85, not 99.
I get to 99. That's what I like. I like 85. The move from 85 to 99.
And listen, this is my preferred mode. Okay, you have people that are just disgusted. I'll never touch this stock again, and then something happens. There's a positive catalyst, and it has to get re-rated. If this takes out 39.40, you probably have another, I don't know, 8-10 points without too much trouble.
Yeah, my thinking here is that it goes back to $70, $60 if it works. But I don't know. This is my kind of chart. It's like it was hot, it got wiped out. It's been sitting there basing for going on 2 years now.
Yeah.
And we've had some fits and starts, but this kind of reminds me of my Chinese stocks charts where
Yep.
you got some excitement and then it rolled, and you got some excitement, and this isn't as good as Alibaba, but it's like not taking out the $30 level. It keeps knocking on the door of that high 30s level. And, to your point, maybe one day we'll wake up and it'll be a $45 stock, and then, we'll see what happens. But yeah, I endorse the match.
Okay. That's what I have, gentlemen.
Okay, you want to talk about Bungie, Charles?
Sure. I'll do it very quickly. So I mentioned soybeans is something that I've been buying on Monday's show. And then on Tuesday, we got the WASDE data. WASDE stands for World Agricultural Supply Demand Estimates. And the bottom line is for soybeans, production was trimmed, harvested acreage was lowered, or the planted acreage was lowered. And we are expecting lower yields. In the meantime, the domestic crush demand for soy oil is firming up, and because of the demand for biofuel production. So the backdrop of all of that, is very solid for soybeans, which have been in a 3-year bear market, by the way. We're now, and so for the most part, I've been sitting on my hands just trying to do idiosyncratic stuff where I think there is, a catalyst. And so if I look at soybeans, the two catalysts that I'm looking at as we go into September, October, November, one is this starts the harvest season here in the United States for soybeans. And dry, hot weather in the Midwest, which is where the bulk of the production is for soybeans, could lead to significant reduction in yield estimates or harvests. And we saw a little bit of that in the WASDE estimate on Tuesday. So I think there's a chance that the harvest could be poor if the weather does not cooperate. And that would be a catalyst to higher prices. And then the second catalyst is China. Trump did tweet over the last weekend, that he'd like to see China pick up their production of U.S. soybeans. So for the most part, China shifted all of their buying of soybeans to Brazil and Argentina secondarily. But where China places the biggest part of their orders for U.S. soybeans is in that November period. And that's also when the 90-day extension of tariffs with China comes due, is sometime in early November. So I think Trump is going to push China hard on increasing their production of soybeans. This is something he did in the phase 1 agreement way back in his first term. And so we may find out that China is going to start to buy more and more U.S. Soybean production. So I like soybeans. I'm long them, in the actual commodity. But the stock play on that would be Bunge, symbol BG, which is the largest processor of soybeans. And they just reported, earnings recently, a week or so ago, and they beat, in their second quarter earnings, both on earnings and revenues. And, they reaffirmed their 2025 guidance, somewhere around 755, 760 a share this year, and 850 a share next year. So the stock's trading at only 10 times next year's earnings. And if those two catalysts come in, I think you're going, and the demand for soy, the crush demand remains very robust. I think Bunge's, easily a $90 plus stock.
Kevin, do you have the ZS on there do you have futures on your system?
I do.
Let me share. I'll share the chart. It's fine. Take yours off, and I'll just show you, because this does look pretty decent. shares.
Yeah, and if you look at the WASD forecast, they're looking at 1,010 as the average price of soybeans, and we're what, 1,045 somewhere like that.
So can you see this?
Yep.
Yeah. So that's my kind of chart too, Charlie. So just so we're clear, that's the 5-year chart of the soybeans futures. Looks like we spaced out for a year. Now we got the China catalyst and blue skies ahead, right, Kevin?
I want to thank the Allman Brothers for joining us.
But anyway, so that looks interesting, Charlie. I mean, the one thing I'd say about Bunge and Archer Daniel Midland and those, they're hard businesses to value. You know, I've looked at them 1 or 2 times. I'm just like, oh, you know, it's like the margins, their brokerages. It's tough to put much of a multiple on them. You know, they'll do better, but like maybe if I had to, I would rather just do the futures, to be honest. If it was me.
Yeah, I'm involved in both, Ben. So
yeah. That's just my 2 cents.
Yeah, and I'm looking, you know, for a catalyst between now and November, and if it doesn't, I'll be gone.
Yeah, look, I like it. It seems like one of those things where, you know, you risk some, but you're not going to get crushed on that because it's really sitting at the low.
It's been in a bear market for 3 years. So
yeah, exactly, and that's kind of like housing, buddy. And like buying bear markets where you can't buy them initially, you need to like let them sit for a little while. But if you can get involved when they start to like actually move, and you know what? Let me add one thing since I haven't really talked too much. Yesterday you saw biotechs kind of perform, and so that's in line with my macro thesis also, which is interest rates coming down. Now they're not going to help the Mag 7 as much as they're going to help the long duration, like things like my Joby Aviation, things where the cash flows are out in the 2030s. You know, and so you gotta, when you get a lower discount rate, it helps some of these things where people are like going to take more flyers in a barbell type portfolio. So that was notable yesterday also, that the biotechs and even healthcare had a pretty nice day yesterday, actually. And that has been the most hated land of all sectors. XLV has finally gotten a little bid for the last week. I bought that last week, actually, just on a defensive play. But yeah, I think buying bear markets when they're about to exit a bear market is just maybe one of the best things you can ever do in markets. The question is, the hard thing is holding then. Like when do you get out of them? Then they correct and you're like, oh, I should have sold. And then then it somehow makes another move. So that's the real tricky part of that, I think. Yeah. So, all right. Anything else, guys? Or maybe we'll just call it there.
Yeah, I think we've run over.
Rock on.
Run over. Enjoy the day. I am Benjamin Bry. It's Charlie's Peabody's, Kevin Bakes Baker. Come check us out at wallstreetbeats.com or passes.com/wallstreetbeats. And we will chat with you tomorrow.